Assumable mortgage is when you, the buyer, are taking over the current owners of the house or the sellers of the house current financing, right? You're taking over their debt. So if you're buying a house from someone and let's just say they owe $300,000 on a loan and it's an FHA mortgage. Well, before I say that, with assumable mortgage is only certain mortgages that are assumable. Now, we're talking traditional home buying, right? We're not talking investing, okay? Because that's a whole different animal when it comes to assumable mortgages. But for traditional home buyers, they're only FHA, VA, and USDA loans are assumable. Conventional mortgages are not assumable.
Okay.
All right? So that's first things first. Second thing is you need to know is when you're doing an assumable mortgage, you have to go through the seller's current lender who they pay the mortgage to qualify for that mortgage that the sellers currently have. So if the sellers owe currently $300,000 at a 2.5% interest rate on an FHA loan, and you go through the seller's lender that they currently pay the mortgage through, and you qualify, then you can potentially assume their mortgage. So let's just say they bought the house 5 years ago.
Okay.
Right? Or let's just use round numbers. They bought it in 2020.
Right.
Right? And they brought it, they started the loan at $350 and today they owe $300 and it's a 2.5% interest rate. And they got they've been in the house for 2.5 years now.
Okay.
So they got, 27.5 years left on the mortgage. So you're assuming they stop, right? So you're going to have a 27.5 year term. You're going to have the 3% mortgage with the balance of $300,000.
You have 3% or 2?
2.5, whatever.
Okay.
I'm sorry, 2.5%. I said it was right. So you'll have whatever their terms are, 2.5%, whatever their current balance is. If it's $300,000, and if they only been in the house for 2.5 years, then you have 27.5 years left on the term of that mortgage.
Okay.
So you're assuming the current debt that they have.
Okay.
Now here's the flip side. Here's the con of assumable mortgage. Let's say their house is worth $500,000.
Okay.
And you're assuming their mortgage for $300,000.
300.
$300,000.
Okay.
There's a $200,000 gap between what they currently owe and the value of the house. What do you think has to happen?
So they've already paid $200,000.
No, I didn't say that. They owe $300,000 and the house is worth $500,000 and they're selling the house for what it's worth at $500,000.
Oh, I had it the other way around. I thought you meant that they
Correct.
already paid $200,000.
But you're assuming their current loan at $300,000. But they're selling you the house for $500,000.
So that's a come up for them, isn't it?
For who?
For the seller.
How?
Because now they have that equity.
Yes, the seller has the equity, correct.
Right.
So now the buyer has to pay that difference out of pocket.
What difference?
The $200,000. Because they're selling you the house. So let me break it down more in layman terms.
Okay.
I'm selling my house to you, Tukes.
Okay.
Okay? I owe $300,000. It's an FHA loan, and I have a 2.5% interest rate. But I'm selling you my house for $500,000, and you like, yo, Matt, if I go through the bank right now, my bank, I'll get like a 6.5%, and I can't afford that. But at your $300,000 and 2.5%, that's a payment I can afford.
Right.
But I'm like, Tukes, my house worth $500,000, and I want my $500,000.
Okay.
So there's a gap of $200K.
Right. So what happens?
You got to pay me $200K.
Out of my pocket?
Yes.
Oh, nah, we ain't doing that then.
Then congratulations and go with your 3.5% down at 6.5% then.
So this is a play more or a tool rather than because
this is a tool and a play if you got money.
Okay, got you.
And it's a play and a tool if you meet a seller who might not have that much equity.
So basically, it depends on what the house is actually worth.
worth and what they owe. So if they are in a position, if they own the house for years, and now we see what home prices did,
Right.
people got a lot of equity. But if they're in a situation where, yo, they brought at the top of the market and they're trying to sell it a year or two within,
Right.
and they have a good interest rate that's lower than the current market, but they might be a little tight or a little bit no equity or minimum equity, right? They can't afford the house. No matter what the rate is, they can't afford it. They need to get out of it. And now their rate, let's just say their rate is 3.5% or 4%, but the current market is 6.5%. You know, that's still why it makes sense for an assumable mortgage, because now that difference, let's just say it's 50,000. Bet you can handle that,
Yeah, yeah,
right?
yeah, yeah.
And you assume it. So the assumable mortgage play is really good when the seller doesn't have a lot of equity, or if you're a buyer who just was going to put that amount of money down anyway. So if you got the capital,
Yeah.
if I'm a person buying a 500K, let's just say I was going to put 30-40% down anyway, because I got the money. So now, yeah, it's a play. I can assume your mortgage. But now when I assume your mortgage, remember, if it's an FHA loan, you're going to still have that PMI,
See that?
even with putting that amount down. So it might not make sense for you. But check this out. If they have a VA loan, even if you're not a veteran, you can do an assumable mortgage with a seller who's a veteran who has a VA loan, and VA loans have no PMI, and they always have low rates. So if you find a veteran who's selling a house
Right.
in that particular situation, even if you had to put a larger down payment, you can still come off and win on an assumable loan strategy.
Does the money that you have to pay them the difference? Let's say if I had to pay the 200,000, is that something that I, like you as a seller, can say, you know what, I don't need the 100,000, just give me 100. I mean, I
No,
don't need
fuck
200.
that. Why would I say that? I mean,
Right, but it's an option. So
I
it's something that happens
can.
behind the scenes, or it's
Yeah.
something that's on paper.
No, it's on paper. So
Okay.
you got to bring it as cash to close.
Right.
Because now, again, remember we was talking about Garland Gardens and people selling house for dirt cheap or whatever the case?
Then it messes up the
It
value.
messes up the value of everybody else's house. But if I'm a seller and I have tons of equity, I'm not desperate.
Right.
You know what I'm saying? But if I'm a seller who might just can't financially afford, and I don't have a lot of equity in my house anyway, now that me having an assumable mortgage can be attractive to a buyer now, because instead of them getting the market rates, they can get what I have currently.
Right.
Now, assumable mortgage is a process. It could take 45 days. It could take 60 days. So you got to set your expectations too when you're doing an assumable mortgage. But it's a play if you have the money or you find a seller who doesn't have a lot of equity in the house.
So how does this make it any different from if you're buying or taking over a loan from somebody? Let's say if your mom or somebody can't afford to make payments. Is it the same thing?
It could be the same thing, right? It could be if you're doing an assumable mortgage. You could just do a quick claim deed if it's your mom, and just do a quick claim deed, get ownership, take over payments, make the mortgage payments out of your own bank account, 6 months, 12 months, and then refinance, because now you're an owner of the house, and you could just give some mom some money like, hey, this is my house, here's a couple dollars, and now I'm going to take over,
Right.
and I'm going to take you off the mortgage, the deed, and I'm going to put myself 100% owner on the deed.
Right.
You can do that too without, going through an assumable mortgage process. You can always do a gift to equity sale. So if the mom has a lot of equity in the property, she can gift the equity, and you can use that as a down payment and closing costs.
You can gift equity?
Absolutely. You gotta have like 25% equity, because now you gotta do at least 20% down payment with the equity and the closing costs. But yeah, there's a lot of plays in this.
Damn, I didn't think you could do that.
Now, mind you, all of this talk we're talking, let me just say my disclaimer. This is not for investment properties. This ain't for properties and LLCs. Please don't be in the comments asking these questions. Okay? This is only for primary residences, people.
Yeah, that's crazy. I didn't even know that. So the equity is based on the market, basically, on whatever the house is worth at the time.
Correct.
So if mom had a house and it was $300,000 like 10 years ago, and now it's worth $500,000, that $200,000 of equity is what she can give to me?
Correct. You don't get it in your pocket, though.
No, but I'm saying, where does that money go? It's
used for the transaction. It's you. So if she's selling it for 500 and she owes 300, but you Tooks don't have no money,
Yeah.
but you can afford those. You can afford the payments.
Payments, right?
Bet. I'll give you a gift of equity. Let's just say she only wants 100,000 because you're my son.
Right.
A profit for her pocket. So she owes 300. So she's gonna make the price 400,000. We're gonna use the equity, boom, 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 to do down payment, closing costs. The bank that she owes will get paid the 300, and her net proceeds will be 100K, what she wanted.
Damn, there is a lot of plays. There's a lot to this, man. There's a lot of layers to real estate.
Well, this is why I'm MG the Mortgage Guy, and I'm here to give you guys all the information that you need to
That's
execute
crazy.
at a very high level.